What's up, everybody? Welcome to my channel. And in this video, we're going to talk about some things that are definitely going to go into the stock market history book and how some people literally became millionaires overnight trading options with zero edge and putting unnecessary risk onto the table. It's going to be a very good video. I go into my insight about what I could see happening for the future. So make sure to stick around. And if you're new here, please hit that subscribe button down below and also follow me on Instagram. I post daily trading recaps along with very good trading tips and tricks. The link to this will be in the description below. It's definitely a very good resource. Without further ado, let's get right into the video. Let's first get a little more context of this situation. So up here we have a Bloomberg screenshot, which basically represents an index that tracks the most shorted stocks in the US equity market. And in 2020, the full year in its entirety, we had pretty much from low to high one of its best years to date, and it was at 49%. Now, this index in January alone of 2021 is up 54%, which already beats the index from the full year last year. Now, this picture, again from Bloomberg, basically represents Goldman's breakdown of a breadbasket of stocks owned by hedge funds. And as you can see, this chart is significantly coming down, almost to lows back in 2014. Now, what this represents is many hedge funds being forced to liquidate any long positions they have in their portfolio, whether it be good stocks, whether it be bad stocks, whether it be volatile, unvolatile stocks. They're forced to sell winning positions just so they can cover any losses from any shorted stocks that have been squeezing and they are losing on those positions. And they also need to liquidate to cover some cost from any margin calls they've received or just any losses that they have incurred from major short positions. That brings me into GameStop. I'm sure you've all heard about this week. A couple months ago, this was a $2 stock. Now it's 385 bucks. Absolutely wild. People are making tons and tons of money on this, millions of bucks trading the call options, even trading the shares itself. Definitely a lot of money that was made. Does not mean you have to have FOMO. This is just a very highly shorted stock. If I pull up the stock short list, you're going to recognize some names. We have GameStop. We have AMC from today. We have Bed Bath & Beyond. We have Fubo. So a lot of names that made crazy moves that a lot of people are talking about that are hyping up all have high short interest. Just to get some more context, I made a video on this last week. I'm going to briefly get into it. I will link this if you want to watch it in the description below. But GameStop, this video was on how GameStop has some very high institutional ownership. It's has a high percent owned by institutions, by big hedge funds, mutual funds, big banks. So on top of that, we also had a high short interest, which you all just saw. If I pull up this chart, we have 138% of the shares being short. Now, people are going to say, how does that make sense? We have something called an upside down float, which basically states more shares are being held short than the actual float, which are the shares available to trade on the public. So we have an upside down float, and short sellers are technically buyers because for them to close the position, for them to cover, they have to buy. So many factors which are driving this squeeze up. We have a large army of retail traders buying this. Wall Street Bets, I'm sure you all know them. Shout out to them. It's a bunch of like-minded people buying the same stock together. They think it's going to increase in price. So in result of that, shorts begin to cover, which is bullish itself because prices are going to squeeze higher, which causes a massive short squeeze. And then we also have something called the gamma squeeze, which all have to do with stocks that have options being available to trade. So a gamma squeeze is also leading this move up, which we're going to break down. Any stock that has tradable weekly options and a stock that has a high short interest is a prime contender for a huge gamma squeeze if led by, a huge army of people trading far out of the money options. So just really fast, short squeeze is when we have new buying, when we have breakout traders or any type of new buying looking for prices to increase, combined with shorts stopping out and putting more, fuel to that fire. A gamma squeeze is the same exact thing, but when you add a third variable to it, it becomes, 3 times stronger than a short squeeze. And this is what we've been seeing with names like GameStop and AMC that have these tradable weekly options. So not only do you have new people buying, you have traders, like I said in my last video, my uncle who has no clue about the stock market texted me and said, what's going on with GameStop? Should I buy? So you have traders that are hearing, buy AMC, buy GameStop, buy Fubo, buy BlackBerry. They're hopping on it, they're buying it. So right then and there, they're fueling a move higher. Then you have shorts stopping out because price is increasing. So again, more gasoline to the fire. And now you have option sellers or who are hedging their positions, which again, those people are fueling more flame to the fire. So if I pull up AMC here, this is very similar to GameStop. AMC was, just in this time period, a $2 stock. Today hit a high of 25 bucks, so a little over 1,000% change. And yesterday we closed at around $4, $5. And today we hit a high of 25 bucks, so about a $20 per share increase. This is a prime example of a gamma squeeze. If I pull up the PowerPoint, if we look at the $9 strike calls for this week's expiration, they were trading at 4 cents yesterday, and they traded to a high of 15 bucks today. That's a 37,000% return. You have option sellers who are hedging the positions because you have a large army of retail buying way out of the money calls for highly shorted stocks. And that's just going to keep putting that fuel in the fire. This is going to continue to go on as long as we have a huge army. There's no regulations that are being put in. And we have a huge army buying these out of the money calls out of speculation that higher prices are going to, keep going up. So if we go to my Thinkorswim, I show you the AMC. If we go to the option chain, go to the 9 calls, we put them back into Thinkorswim. This is what the 9 calls look like. Yesterday, they were going for 4 cents, way out of the money. There's absolutely no risk for option buyers. Not for sellers, they have a huge risk. Option buyers, if you buy at 4 cents, let's just say you buy 10 contracts, so you have a risk, the most you can lose is 40 bucks. Today, you would have woke up with $15,000 profit. Straight from this, $40 original investment, and that's the most you can lose. It's a 37,000% return, and that's basically what a gamma squeeze is. If we look up GME, if we saw it from last week, if we go to the option chain, we might not even be able to see it, but there were way out of the money options being bought. The stock was at I want to say 100 bucks, and they were buying the 200 strike calls. They were buying way out of the money. And, a $200, $300, $400 bet turns into, a $100,000 winner, and it squeezes. It has a monster influence to the market and has a monster influence to the actual options itself. So as the stock moves up, every single call seller, let's say in this example for AMC, let's say we delta hedged at $10. We sold the 10 strike calls. We sold the 8 strike calls. Now AMC's at $5. You have all of these call sellers down here that had huge risk on them are now completely underwater, and they continue to fuel, more moves higher as retail becomes more aware of this. Same thing with GameStop. When this was trading at 100 bucks, even 60 bucks, we had traders buying the 150 strike calls, 200 strike calls. Now that they're so far in the money, those option sellers are completely underwater. Their hedges are completely, squeezing the market higher, and you have traders that are selling these calls completely stuck down here, hoping in desperation for price to come down. Now you have some stocks that don't have options, like NAKD today, which is a pure squeeze from a retail army pumping this stock up higher with a very low float. This had a volume today of 2.2 billion shares that were traded, and this has a very low float. This went from 35 cents all the way to a high of $3.50. So about 1,000% return. This was a pure pump of shorts being stopped out and new breakout traders, new retail buying. We have Bed Bath & Beyond, BBBY. If you look at this list here are just, some names. I'm sure there's more. If there is, comment them in the comments below. But, this thing is crazy as well. We have Nokia. Monster move today. So it's a reoccurring theme We are going to keep seeing it as long as we have no regulations and we have traders buying out of the money calls for highly shorted stocks and people buying the actual equity itself and short sellers becoming, way underwater. All of this ties back into the overall market itself because as we have more stocks being shorted and we have these massive crazy squeezes, you have hedge funds that have bearish positions and having margin calls. They're having to sell their, cover their asses. They're going to have to liquidate some of their positions so they can build up more equity to cover those losses that they did incur. When you liquidate a position, you have to sell it, and in result, the market is going to come down. So just in my opinion, as long as we keep seeing these squeezes, I can see the S&P 500 keep continuing to move down, just as these hedge funds have to liquidate their positions. They have to sell, if they have a huge good winning position on Apple, they might have to sell that position if it has a large equity stake to raise capital in order to, cover their losses on the positions that they got squeezed out on. So here we have the S&P 500 today, and this was in the pre-market plan. I also posted this in the intraday commentary tab in my chat room. So we opened up and we had a nice sell-off. So this sell-off created a nice supply zone. So we started bouncing kind of artificially up into this 3,800 level and into this sell imbalance. So whether you're new to my channel and you don't understand supply and demand zones, a supply zone is an area where we look to sell the market. We look to take bearish positions. So from an intraday perspective, as long as this is considered unfair value to the sellers or to the buyers, and sellers are responsive and take this lower, this is going to be a high probability area where the market could possibly turn. So going into my Discord room, I said this is a major area for me. Supply was created at the 3793.25 area. If we reject and stay below VWAP, this could be a nice shorting opportunity. So we came into the zone, we had proper confirmation, volume was decreasing, and we slowly started to come down where we started to have somewhat of buying activity right at this double bottom formation on the S&P 500. So again, this drop created more supply because of this run up right here where you have longs being attracted into the market. Now as price comes down, we have these longs which are under the water. So now you have to have responsive buying in order for price to continue up. But if that responsive buying is met with responsive selling, price is going to continue going lower. So I noticed that, and we also then formed new supply inside of old supply. So I wanted to see a move into 3779.25 for another leg down. We were currently double bottoming. So if I show you where that supply formed, put these zones here. It was in this area right here. We moved into it. We rejected VWAP perfectly. This sold off. It also formed the perfect wedge where we were consistently making lower highs and we were also consistently making higher lows. So once this wedge broke, we rejected supply. You have two reasons to take that trade short. We started selling off. Volume was increasing during the down move, which gives us more conviction that this move is going to continue. And we sold off right into end of day, right into this demand zone, which we're currently testing, and it does not look very convincing, to bounce. So that's just the power of finding supply and demand zones intraday. You find these setups, they form, before the market's open, during the market's open. These are areas where you want to see sellers interested at supply with proper confirmation to take the trade short, and you want to see buyers very responsive at demand with proper confirmation to take the trade long. If you did enjoy this video, you learned something from it, and you enjoy my content on the channel, I would greatly appreciate it if you would just subscribe, follow me on Instagram, and also smash that like button for me. I'll see you all at the next video. Peace.